Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at Sherwin-Williams, the paint store company, and do a stock analysis on them. But before getting into the analysis, make sure to subscribe to my channel. Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks, want to get potential ideas on stocks to buy, the value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a stock, leave it in the comments below. And also make sure to like the video, since that will help it in the algorithm and get my channel going again. Since you can see that in the past, I was getting more views on a lot of videos. And then when I kind of restarted after taking a little break, the views are a little bit lower. So do what you can to kind of help restart the channel here a little bit. So getting into the analysis for Sherwin-Williams, basically we're going to look at some of these top level metrics here. Get an idea where they're sitting at. You can see they're sitting at a relatively high P ratio of 30.73, which is not obviously something you would expect for a paint store company, but I'll be explaining basically why this currently is. And they do have a forward P ratio sitting just under 27, implying there's a little bit of basically EPS growth going forward in the future. And how have they been returning capital to shareholders? Well, through the dividend and share buybacks. It is sitting at basically a relatively low dividend yield of under 1%, and still the payout ratio is 0.27. And also a relatively low average share buyback ratio of 1.5. And these are one of the problems that kind of happen when you basically have a high P ratio, because typically companies which should be growing a lot have higher P ratios. They're not going to be returning the capital to shareholders as much because they're going to be reinvesting in their own business. So that's one thing we really kind of have to look at to see what Sherwin-Williams is doing and if they're getting a good return. And on the little chart here on the right, you can see the blue line represents their longer term revenue trend line, which is at 6.5%. The green line is basically the analyst estimates, which is a little bit lower, closer to around 5%. But they have been able to even outpace the 6.57 on a per share basis, because over the last 10 years, it's been about 9.3% for revenue, and on a per share basis, 12.5% for EPS. So that is, some decent growth overall. So one of the first things to look at, and is, kind of relevant for a company like Sherwin-Williams, is the return on invested capital. And you can see right now it kind of has lowered over time, and it's sitting at 13.3, and the weighted average capital has been creeping up to 11.87. So this isn't, in my opinion, basically the best. You can see over 10 years ago, return on invested capital was in the 20s and the 30% range. So that was, actually a lot better, and their weighted average cost of capital was lower as well. So definitely, as the company is basically getting bigger, they're struggling to get basically returns as they expand their operations. So this is kind of one of these problems, which I'll kind of show in the future in the rest of the analysis on Sherwin-Williams, that may be a problem that'll be start developing a little bit in the future. And overall, while the revenue basically has grown, you can see kind of since 2022, things have not been growing pretty quickly, with only just over $22 billion of revenue in the year ending 2022, and in the year ending last year, 2025, it was basically now at 23.57. So that's been quite low growth. But at the same time, during those periods, they were able to expand their gross margins back up. And while they are sitting at 49% right now, this is a little bit more on their historically high side. And about 10 years ago, in 2015, 2016, they did have similar gross margins. But one place they have been able to basically continue to expand is on their operating margin, as their operating margin actually has been going up and up and up and up. And I think is that relative the higher level, at least in the last 10 or 20 years, sitting around 16%. And this is one of these things that the institutional investors basically will give companies premiums for if you're expanding your operating margins. And if you actually go into their investor relations here in their little presentation, they kind of do say one of their financial strengths is this margin expansion opportunity. So not only have they been expanding their margins a lot in the past, they're kind of saying, hey, we're going to be able to continue doing this in the future. And that maybe is what the market basically is starting to price in a little bit right now, based on the higher P ratio, or at least those are their expectations. And we can see basically that leaves operating income of just under $3.9 billion. They're basically their interest expense sitting just under $500 million. And I usually like to look for at least a 1-to-10 ratio to say it's good. So this is kind of just outside that good range there. And this is probably one of the reasons the weighted average cost of capital basically is starting to creep up, because if, the more debt you take and everything, the more interest, and their debt basically gets more expensive, over time, the more leveraged you're going to get as well. So anyways, this is something you kind of want to watch in the future. If they were to do any more big acquisitions and this creeps up a little bit more, it could start, kind of squeezing their operating margins a little bit. But In the current time right now, things are still looking pretty good. You can see the net margins just under 11%, and this is, pretty historically on the higher side compared to the longer trend here with, net income around $2.6 billion and a little bit of share buybacks every year, again, because they've been fetching a higher P ratio. They aren't able to actually buy back very many shares, which, it makes it actually very slow to reduce the share count. And looking onto their balance sheet, there's nothing too spectacular on their balance sheet. You can see that, total current assets, 6.5 billion. Current liabilities sitting at 7.5. So yeah, it's not a good basic current ratio, but for larger companies like this, they don't necessarily have to run good current ratios. And they also have basically aligned to some, short-term debt and credit they can, always get if they need in the short term for liquidity issues. And you can see that even in the total current liabilities, they are actually running a little bit of short-term debt right now of almost 2.4 billion, which is a little bit more variable rate, which is a little bit on the higher side. So compared to the past, at least. So this is something I would probably want to see them tick down a little bit and pay down. And because it is shorter-term variable, it might be something that they are going to tackle with the interest rates being a little bit higher. You can see the total assets sitting a little bit over $26 billion. But that does include $8 billion of goodwill, and this basically happens when they do acquisitions. This is one thing that has increased a lot over the last 10 years. So you can see 10 years ago, they just had over $1 billion in goodwill, and now that's basically increased by almost $7 billion there. So this is one thing you need to kind of keep an eye on, because in the future, if they ever have to, write down any of this goodwill, well, it's not a cash expense. Will be shown on the income statement, and will make their income look lower. And that is something that basically can be potentially, marked down and, give a reason for the stock to fall in the future. And they also have a few billion of intangibles, well, almost close to 4 billion on top of basically the goodwill. And well, they are sitting at total equity of $4.4 billion. If we subtract out the goodwill, they are sitting at negative total basically equity, which really, for a large company, it usually isn't the biggest deal because they have, pretty cheap debt, access to capital. But it basically is saying that their, balance sheet isn't in this, very, very, strong, fortified, place to weather potential storms that could come in the future. Even though, again, in their thing here, they say they have a strong balance sheet, which I will disagree with a little bit there. But in their current state right now, it's fine. It's not a big deal. So in the cash flow statement now, usually where you can find some interesting things, you can see basically this is the cash flow from depreciation, how it is being basically slowly rising over the years. But the interesting thing I notice here, and this is what getting into basically the return on invested capital and their slower growth, is they actually have been starting since 2022 to exceed their cash flow from depreciation with new purchase of plant, property, and equipment by actually quite a big amount. So it's kind of interesting that the growth rate is expected to be relatively low, even though they are doing higher amounts of purchase of plant, property, and equipment, when in years before, they were actually a little bit on the lower side. So this is obviously for expansion opportunities, but because of the size of the company, they actually aren't able to grow revenue very much for the amount they're basically investing. And also the return on invested capital is a little bit basically on the lower side. And when you are doing that, they're also doing some acquisitions at the same time here, as you can see in the last year, over $1 billion. And then, there was some little ones in 2023 and 2024, but then another $1 billion in 2022. So the acquisitions is something they seem to be doing a lot more. And we're not seeing a lot of top line revenue growth yet from that yet. And even with projections, we're only talking 5%. And we're also ramping up the purchase of plant, property, and equipment. So when you're seeing that net income at the top, you have to realize that a lot of that is being reinvested back into the company here to provide a relatively low growth rate. So I don't think that's very positive for the growth expectations that are basically coming for the amount they're having to basically invest. Because once you're using up all this money, you from your net income or your cash flow from operations, you're not going to have very much left over to either pay the debt, repurchase stock, or pay dividends. And we can see what they're doing on that front. Well, they basically, we'll just look at the free cash flow here, a little bit higher than their net income at 2.9 billion, but in reality, they're actually spending more on their purchase of plant, property, and equipment. And then we have around almost $800 million basically from the dividends, and then, the repurchase of stock was almost $2 billion itself. And, that's basically going to mean that the net issuance of debt here is they basically net issue debt to basically be able to, do these activities, to be able to do the acquisitions, do the store expansion, while keeping these levels of buybacks and dividends. So, and they've done this for a few years now. So unless they really start increasing their debt by actually a significant amount more, I would expect them to, sorry there, I would expect them to basically have to cut back on their repurchase of shares to kind of get that short-term debt, like I was saying in order before, since that's been what's increasing the last little bit. So they're probably going to be focusing on that. So I wouldn't expect as many repurchases of stock basically in the short term at least. So let's get into the interactive chart, look at a little bit of the relative valuation. Basically, we can bring up that same revenue trend here. Oops, I'll need to double click it there. And if you want, you can, look up here and see basically what the exact numbers are. And you can see, again, this is like averaging around 5%. So for all the money that's being invested in like all these acquisitions here, really hasn't been growing the stock very much, in my opinion, but they are at least managing to keep the operating margins going. And then also we can look at the EPS without non-recurring income with estimate. And this is where it gets interesting, because in the current year here, basically the year ending 2026, you're not expecting a big EPS growth, but then they're kind of really expecting things to ramp up above 10%. So this is kind of pricing in that they would be having to have operating margin expansion along with some reasonable share buybacks to basically be able to fuel this type of EPS growth, which from the debt we were looking at before, the short-term debt they're going to want to be paying down, I don't think they're going to be able to do that level of buybacks, especially at the current P ratio. So I think these are very optimistic. And then if we're going to bring up the margins now, an idea with those. And we'll pick up the growth margin first. And you can see it's sitting a little bit at the higher side. So I can't really say this long-term gross margin has been on an uptrend. You get these cycles high, it comes back, down, and things, seem to be peaking a little bit potentially again at this level. If they were able to get higher, that would be great, but that's not really where they're going to get the expansion. But if this does come, contract a little bit back to the normal level, say around 45 even, you will see the hit on their bottom line, which definitely means they can't be buying back shares. The operating margin obviously has been looking better, and you can see there has been this long-term increase in the operating margin. I think this is really what has been giving the stock its current premium of a 30p ratio, because really the growth and like other factors about the company don't seem all that, actually great in my opinion. So right now it's like in my stock analysis, for example, on Costco, when I actually did one a couple years ago, I said, I don't think they're going to be able to keep expanding their operating margins because of their physical store presences, yet they still kept doing it. So by all means, Sherwin-Williams, if they are able to keep expanding these operating margins, that could keep them at a higher lofty PE and kind of keep the stock generally trending up. But I do view this as a pretty large downside risk, because if things were just to kind of like contract back to this 13, which historically is still like pretty good and really high for them, the market wouldn't see it. At least, institutional investors would say, oh, they're not expanding their margins anymore. There's, financial strength here of the margin expansion is not happening. It's actually a contraction, even though maybe it's just some fluctuation normalizing. So that is a big headwind risk that could happen. If you ever see these net operating margins tick down, well, that's definitely going to, hit the stock there a little bit. And anyways, we can also bring up the price to sales ratio, because that usually goes, hand in hand with operating margins. And we'll get a little bit of a lower time frame here. And just kind of remember, like this point here, 2014, or actually 2014 and then 2020 is really like it picked up a little bit here and then picked up a little bit again there. So we can take off the operating margin to see what our relative valuation has been. And you can see when basically before 2014, with lower operating margins, it definitely traded a lot cheaper. It's like, trading below a 1 price to sales ratio. And even on the high side was maybe only getting up to a 1.2. Then at 2014, which might be a level we would normalize back to, because I don't necessarily think the company is going to collapse, but I could see a reversion back to these kind of previous operating margins, where it was trading a little bit under 2, maybe, like 2.5 on the high side. And then going forward, when they kind of expand a little bit more after 2020, even during 2022, that bear market there, now the low was 2.5 for the price to sales, and the high was getting up to 4.7, and we're sitting at 3.34. So even based on these recent operating margin levels, the stock is definitely not on the cheap side. And if it were to get a little bit of contraction in the operating margins, you would definitely see a repricing at least back down to these levels, which I think opens up a lot of downside for the stock. And we can kind of see the same story also with the P ratio as well. It's a little bit cleaner since you don't need to calculate the margins, versus that and everything. And let's just go there. And you can see it's sitting at a 30 PE. And even during 2020, I guess 2023 was actually the very bottom for it here. It's like even at the lowest it got was a 25 P ratio. And at its height, it was at a 50. And this is one of these things that's kind of happened with a lot of stocks that kind of really threw off the financials and this and that because of after 2020 and the changes, short-term changes and everything, is a lot of stocks just got to these really, really high multiples, which honestly, in my opinion, really didn't make sustainable sense. And a lot of stocks, like one that we just did a stock analysis on, FactSet or Lululemon, those used to trade at these really high multiples. Now they've compressed down basically to around closer to 10 P ratios. So that kind of, this does show you that if Sherwin-Williams shows basically any weakness, that is something basically they could see again. And even basically look before, 2016, things would maybe get down at least to a 20, and then, 32 would be on the high side. But they're definitely now we're more in this we're mid 30s, high 40 P ratios. And, pre 2014, again, it was more normal because the operating margins were lower. Well, it's trading at like a 15 and even, down to almost a 10, which is kind of more for everything I've looked at this company is kind of more what I would honestly be willing to basically pay. Let's also just pop up their dividend yield here. I actually just get the relative analysis for that, because the one thing you can typically find is when the dividend yield spikes for consistent dividend payers, that's sometimes the better time to buy the stock. But I think we bring up the payout ratio here as well. Dividend payout ratio, because you also have to compare that additionally as well, because you can see a little spike there. So it's like they've never been a big dividend payer basically in the past, but I think for a slower growth thing, you would probably eventually want to see the stock being, at least a 2% dividend payer going forward in the future. And I just want to see, before we jump into the stock chart, we're just going to take off the dividend yield here. And the payout ratio is basically been fluctuating, so it's really hard to get a accurate view of that, but not a big dividend payer. And then in our stock chart here, basically you can see the longer term trend I have, which has actually since 1990 basically. And we definitely are in this upper channel trend. And you can see when the operating margins did jump up in 2014, that basically is what propelled it to this upper trend here. And you can even see from the moving averages, things are starting to moderate a little bit. And even when I have this level here, this is honestly when I would start getting interested in the stock myself. And, that would be a pretty big haircut for the stock. It might even take a couple years for it to get down. But then at that point, it would be trading at probably a more attractive P ratio, though you kind of will have to look at the financials of the company, since if they've taken a lot more debt or, if there's been some deterioration on the balance sheet, that can also change things as well, as there is the potential of that happening. But, that's kind of what it is for Sherwin-Williams. It's, just looking quite expensive. It's kind of like even going into 1998 here, they started topping and, they had a very long time, basically. This is 5 years from top to kind of this whole consolidation. So we could very much see, something similar to that again. Doesn't necessarily have to be a big crash. It has to be relatively slow. So let me try to find my projection tool here. Get where all these things are all the time. I want bar patterns. So if kind of give you some idea on the time frame there, this is kind of projecting. Oops. Anyways, something like this here. And anyways, if I got to this, the yellow moving average here on the monthly time frame, which I believe is my 150 month, that's kind of the place I would start looking at it then. But right now with this trend here, I think there's just very limited upside, and that's really just betting on this margin expansion story, which it may keep happening at the long term, but it's or not the long term, but in the short term. But it's not just something that I would consider to be something reliable. I would want to basically pay these prices for. As you can see, this like long-term trend here has been about 12% per year, and that's basically what the EPS growth was over the last 10 years. So especially when they're slowing down, it may even be hard for them to keep this type of growth going forward in the future. So anyways, as you can see, I don't really think Sherwin-Williams is a good value right now. You have pretty limited upside of kind of just going along with this 12% trend if they continue expanding their operating margins. But then on the downside, it's, I think, very easy 50% downside, or potentially even a little bit more. As we can see here, down to here is like 35, and you could get to 50 if it got a little bit worse, if things were actually to get a little bit worse. But even in keeping a good scenario, we're still actually looking at 35% downside minimum there before potentially being interested in a potential buy zone for the stock. So anyways, that's kind of my thoughts on Sherwin-Williams. I hope you like that stock analysis. Make sure to subscribe to the channel, like the video, of course, and I will see you in the next stock analysis.